Houston, we have a problem. The S&P 500 has just entered its first correction since October of 2022. This comes in the context of rising interest rates to levels we haven't seen since 2007, strong economic and GDP data, and optimistic inflationary data that is showing us returning to the average of 2 to 3% on the CPI. And although most of big tech companies beat analyst EPS and revenue estimates, it turns out that markets don't just like going straight to the upside. Instead, there's a lot more volatility that an investor has to go through, which just so happens to be what we're going through right now at the end of October. Although the bull market of 2023 lasted for a very significant amount of time and surprised most folks on Wall Street, this correction that has been coming on the S&P 500 is not as surprising. Because, folks, the reality is small cap stocks have already been underperforming the entire year and have not entered a bull market since the pandemic has started. The IWM, for example, is down 1% for 2023. Meanwhile, after the 10% correction we've seen in the S&P 500, that ETF is actually up 17.7%. This kind of disparity between the performance of the biggest of biggest companies to the smallest of smallest companies is actually very rare. And that right there, folks, is why the portfolios of most retail investors have barely moved up in 2023, because as we all know, most retail investors don't buy the big tech stocks. Instead, they buy more consumer-facing, smaller companies with higher growth potential. And as it turns out, it's these smaller companies that are most adversely affected by a monetary tightening policy through rising interest rates. The balance sheets, the growth prospects, as well as the profit margins for a lot of these companies are much more affected by the likes of your Amazon, your Facebooks, your Google, or your Microsofts, because the largest of largest companies not only have the best balance sheets, but they have the best pricing power because of them outcompeting the competition. Whereas when we're talking about smaller companies, rising interest rates make it harder for them to raise money from not only banks, but investors and institutional investors, which is exactly what stocks are trying to price in over the past 12 months when it comes to small caps. However, folks, as bad as the situation seems, right now is actually not the worst economic time for small caps to be existent in, because GDP data, retail sales data, as well as economic growth projections are showing a strong amount of resilience in the US economy. This so-called recession, folks, that had been talked about for so many quarters has simply not materialized. That isn't to say we couldn't get a recession within the next few years based on the yield curve steepening, which typically signals a recession coming once it starts inverting back to the zero line. But it certainly does mean that stocks could be front-running what is happening in the bond market. Because historically, whenever the yield curve has inverted, stocks actually perform pretty well. It's typically when this gray area on the chart comes up, when the recession hits, economic turmoil hits, when stocks start to tank. And the important differentiator in today's market is that we're witnessing an inflation-induced economic slowdown. And in many cases, calling it a slowdown is probably a massive injustice. Essentially, we could call it a correction because of a return to normalcy after the boom following the pandemic. Especially for those investing in growth companies and startups, this is a very important way to look at this situation. Essentially, in the pandemic, the government issued way too much cash to people who didn't need that much cash. That led to a lot of spending, increased prices for businesses, record profit margins, record low inventory, and supply chain bottlenecks. That resulted in a wealth effect, as well as new jobs being created left, right, and center by Google, Microsoft, and all the other businesses that benefited from work from home. This money flowed down to the smaller companies, allowing them to raise a lot of money, allowing them to go public and give new prospects for their business strategies. But as soon as the Fed started raising interest rates in a surprise shift in 2022, markets realized all the cash these companies have is actually worth a lot more than the losses they're making. All of a sudden, the companies that didn't really make a profit saw the worst declines in their share price in near-term history, as clearly seen by this chart for the Russell 2000 Small Cap Index. If you're investing in these kinds of companies, you have not had a bull market since 2020, and most retail investors invested in these stocks at the highs when the businesses were flourishing and new IPOs were happening left, right, and center, including yours truly. But folks, now that the tide has turned and people are losing balances on their savings and checking accounts, we're seeing a return to normalcy to pre-pandemic levels, which means a lot of these companies that are better off than they are today in their latest earnings reports than what they were in the fourth quarter of 2019 are potentially still important and good investments. What I mean by that is that the stock market is essentially trying to discount the growth that the markets faced artificially in 2020 and 2021. We're not necessarily going here in the negative like we did in past recessions like in 2001 and 2008. The economy clearly tells us that is not the case. We're not going into an economic turmoil. That doesn't mean we won't be in one in the next 5 years, because obviously economic cycles do exist. But the reality is right now the Fed is forcing this card on most of these small cap companies. This is leading to the S&P 500 also pulling back in the short term and some of the bigger companies starting to lay people off. But it just really could just be a return to the mean. The percentage of stocks underneath their 200-day moving average has accelerated to the downside just over the past 2 months throughout the time that the market was actually going up. And as you can see in 2021 and 2020, we saw an excessive amount of these stocks breach their 200 moving average, which clearly was unsustainable. And right now we're now trading well below the common average of the past decade or so of where this index trades at, which, in my opinion, obviously creates some sort of opportunity. Now, obviously, everything in my videos needs to be taken with a grain of salt because nobody can time the bottom. There is absolutely no way for that to happen, and the next 6 months could be just as brutal as the past 2 months. But the reality is, as an investor, you need discipline and you need a strategy, as well as consistency. And none of those three things can be obtained if you don't follow a simple plan, particularly one that is irrelevant of what your emotions tell you or what the talking heads on social media do. Certainly there's challenges to overcome right now, but the biggest amount of wealth is always created during times of turmoil. And there's some signs indicating that this kind of turmoil might not be as economically devastating as many others in the past. But as usual, folks, let me know your thoughts on this situation down in the comment section below. Are you buying small caps or even large caps in this correction? Let me know your thoughts. Thank you very much for watching, and I'll catch you guys in the next one. Take care.